Namaskar friends, welcome to this guest lecture series. It is the second lecture that we are organizing and it is on collateral finance. And to speak on this, we are having with us Shri Abhay from NBHC. And as I already mentioned, sir, these are the candidates of postgraduate diploma in Agri-warehousing management. Total, it was announced in 2019 January, and so far we have enrolled candidates under 5 different batches. Fifth batch, we completed the enrollment process in the month of May 2021 only. And in total, we are having more than 500 candidates enrolled under this program. Dear friends, before I request Abhay sir to start interacting with you, a brief introduction about Abhay sir. Means, so speaker for today's guest lecture is Shri Abhay Dandwate. He is the Chief Risk Officer of National Bulk Handling Corporation Private Limited (NBSC). He is having 27 years of experience, of which 25-year experience is in core banking, managing various areas related to commercial banking with primary focus on agri-business, rural banking, and SME lending. Prior to joining NBSC, Sri Abhay has held several leadership positions during his tenure of nearly 25 years with RBL Bank, Axis Bank, HDFC Bank, Allahabad Bank. In his current profile at NBSC, he spearheads the risk management and compliance to ascertain the minimization of risk across all verticals. He is also responsible for administrative and functional control of entire audit function of the company. Sri Abhay is postgraduate in agriculture science and has done management in business management. He is also certified financial analyst and certified associate of Indian Institute of Bankers. He has also passed limited insolvency examination from Insolvency and Bankruptcy Board of India. So, this is a brief introduction about Sri Abhay Dandwate, and today he is going to speak on challenges in collateral financing, commodities, managing risk, and ways. So, I welcome you, sir.
Thank you, Dr. Shailendra, for your kind introductions. Good evening to all of you. So at the outset, I am extremely thankful to the manage for giving me an opportunity to share my experience with these budding managers of manage. The manager, I know that it's an institution of reputations. And as I was going to understand that you have started a postgraduate diploma in agri-warehousing management. So these are the students who are already pursuing this course. So I will be in half 1 hour's time. I will be sharing my experience on agri collateral challenges and collateral financing, which is financing against the agri commodities, and the how to manage the risk. What are the different kinds of risks associated with that, and what is the way forward. So in this, we will be talking about, as I told, about what is agriculture commodity finance, how the valuation of the commodity. Then what are the different value chains in that agriculture commodity financing, and what is the role of collateral management in agri commodity financing? What are the different types of risk in the commodity finance, and how to mitigate the risk? And then specifically, I will be talking about the high value commodity and the cold storage fund. As all of you know, that the agriculture is one of the most important pillar of Indian economy, still contributing to the extent of around 17 to 18% of the GDP, though in the last year, the contribution of Indian GDP had gone up to 20% because the other sector could not perform. More importantly, that why agriculture is important in the Indian context is basically, despite making a lot of progress in other areas like in the industrial segment and also the tertiary like service sector, but still the dependence on agriculture in India is around 55% of the populations are still dependent on agriculture, though many of them are in the form of disguised employment. So the importance of agriculture can never be underestimated in Indian context. Though India has made a lot of progress in Indian agriculture in the last 50, 60 years, now we have become self-reliant in almost all commodities barring edible oil. Edible oil, we are still depending largely on the imports. But now the government is focusing their attentions toward enhancing the oilseed production also. So as to reduce our outgoing in foreign exchanges, which goes up to around 75,000 crores in a year's time. As you know, that the agriculture in India has actually this kind of progress has been achieved in the Indian agriculture side, has been contributed predominantly by many factors, but one of the important factor is agriculture credit. Now, agriculture credit, credit is given in the two forms, particularly the pre-harvest form and the post-harvest form. If we talk about from the farmer's perspective, so pre-harvest loan means any loan which is given up to the harvest, means right from sowing to sowing till harvesting, whatever the components which are required for growing that crop and including the expenditure to be incurred on fertilizers, pesticide, all that actually taken care in that pre-harvest loan. That the most predominant form of pre-harvest loan is your crop loan or the Kisan credit card. Another form of agriculture credit is the post-harvest credit. Now, post-harvest credit means a loan is given against the commodities which has already been harvested. Suppose a wheat or a rye, or a paddy or a maize which has been harvested and it has come into the agriculture warehouse. The financing will be given to the farmers against the value of that commodity. Now, why that requirement has arose? Because immediately after harvesting, usually you might be having idea about it that the prices of agriculture because are highly volatile and that depends upon the demand and supply. So the commodity value, the prices actually goes down at the time of harvesting. So that is why immediately after harvesting, the farmers may not get the sufficient. Sometimes he does not get the proper price. The price discovery is not proper. So that is why the farmer can take a finance against that agriculture produce after keeping in the warehouse, so that his working capital requirement for next crop can be taken care of. Now, the importance of Indian agriculture in agriculture credit is so much high in Indian context that if you know, as you know, that the RBI has already stipulated that agriculture to be one of the important segment of priority sector lending. The banks are required to give around 40 rupees out of 100 rupees. If you talk in a layman language, it's out of 100 rupees, out of 100, 40 rupees has to go into the priority sector, and 18 rupees should go into the agriculture. Means 18 rupees out of 100 has to go into the agriculture segment. Now that agriculture segment again, that out of 18 again 13.5 should go into the direct agriculture. Direct agriculture means loan given to the farmers. Now farmers or farmers or group or farmers, like you can say farmer producer organization, farmer cooperatives, this kind of loans are given. This comes under the direct financing. The EA also stipulates that any loan given to the farmers in the form of post harvest up to the extent of rupees 50 lakh to the farmers, that comes under the priority sector lending if it is given against in case of warehouse, normal private warehouses. If it is given in a warehouse where the negotiable warehousing receipt has been issued, that has been enhanced to 75 lakhs recently. So that is why the importance of agriculture commodity is very much high. So how the value of the agriculture commodity is decided based on which the finance quantum of finance is decided. Now suppose if if the commodity comes in the warehouse, that is wheat. So the determination of the valuation of the value determinant of that wheat will depend upon the quantity. Suppose 100 ton has come, then what is the quality? If the quality is good, then the definite prices will be higher. Then third point, important point is your quality, quantity, and the price. So because prices always keeps on changing in agriculture because it's a seasonal crop. So the prices keeps on changing every time. Sometimes price goes, sometimes the volatility in agriculture commodity is very high. So based on that, the commodity finance. So the value is determined based on the total quantity in the form of tonnages or in the form of bags, whatever it is, and multiplied by the value of that commodity multiplied by the quality, what is the quality. Based on that, the total value of that commodity is decided, and then after fixing certain margin, sometimes it is fixed to 75%, 60%, 75%, 80%, depending upon the volatility. Sometimes some commodity is having highly volatile, then the margin is kept at the higher side. Because of that, why do that banks keep the margin? Because if in the event of margin, in the event of price going downwards, spirals, in that situation, the banks can sell that commodity in the market and recover that money. So this is why this kind of financing has taken up a important place in agri financing in various banks. But what the important point in this that since this commodity is kept in the warehouses, and the value is also determined based on the quality, quantity, and also the pricing, for which the banks do not have the expertise. So what they say that, okay, we will be giving the finance, but we don't have the expertise. So they want an intermediary in between. So they want an intermediary. So who will be acting as an intermediary in the case? Because the banks do not have their own warehouses. If you remember earlier days in 70s or early 80s or 90s, there used to be a key loan. Key loan means the bank used to have their own godowns and they used to keep the commodity. That was predominantly for non-agriculture kind of commodity. And then that key used to remain with the bankers, but that ultimately glimpse of those kind of advances could not be enhanced to a greater extent, and later on that was phased out. Later, when the private sector player came and certain collateral managers like NBHC, one of the collateral managers, and NCML, they came into the picture. They evolved this commodity financing, and which got a lot of acceptance among the banking fraternity. So this is a typical in the entire commodity financing. There is a typical value chain. One is the borrower. Borrower may be farmer. It may be a trader. It may be a processor also. Farmers usually require the finance against their produce, which is kept in the warehouses, because they do not want to sell that auction that stock or sell that stock in the market, because the prices may not be appropriate at that time. They might be waiting that the prices can go on the upward side in the next couple of months. So they would like to keep that stock, to hold that stock for quite some time, but they need money also. So for that, the banks will be financing with that. Secondly, the agri traders or agri processors also, because they will be requiring, because this is a part of, because they will be requiring to keep their stock. The processor will be required to procure the stock, because the agri commodity is a seasonal commodity. So that the commodity will be available only for 3-4 months, while the requirement will be there for entire 1 year. If you talk about sugar, the sugar cane will be available. No, sugar cane is a 1 year crop, but predominantly it is available during. Similarly, wheat, it is available during the specific period, or rice also. But the requirement of the wheat will be there throughout the year. So they will be requiring to procure that commodity in the large quantity during the harvesting season and hold that stock till gradually they will be using it in a phased manner. So that they will be requiring a finance against that commodity. So traders and the processors also require. Now come the financial institution. As I told that the financial institution like banks, sometimes NBHC is also financing. So they will finance against the commodity with the value of the commodity to farmers. Thirdly, the warehousing. The commodity has to be kept in that warehouse, because they have to. It's a perishable commodity, so the quality will be deteriorate. So it requires a scientific storage, and also it requires a continuous monitoring of the commodity, for which owner or a warehousing entity comes. The fourth one is the collateral management. Now, what to say that because in the warehousing segment, predominantly the warehousing is in the unorganized sector. If we talk about that, most of the warehouses are smaller kind of warehouses, which may not be having enough of expertise in handling this commodity. So the collateral management roles come into. These are the specialized entities who can do a specialization of taking care of that commodity in terms of its quality checking, in terms of its quantity measurement, in terms of its monitoring, in terms of its weighment and all that kind of, they have a expertise. So they come into the picture and they give they enter into an agreement with the banks. They say, okay, this commodity will be kept in the warehouse. Either it may be kept in the warehouses which is owned by the collateral management manager, or maybe a third party warehouse also. So the collateral management, what they will do, they will go and check the quality, they will check the quantity, they will check they will fix it, they will also be having expertise about the price pooling also. So they will give the pricing also. Based on that, they will be giving the valuation of the commodity, and based on that, they will issue a storage receipt, which is called a SR storage receipt. Sometimes warehousing, which is, if it is a licensed warehouse, they issue the warehousing receipt also. But if the collateral management is also there, so that again the collateral management will issue its own SR against that underlying warehousing receipt, and that SR will go to the bank, and banks will finance against that that kind of warehouse receipt. They will finance it against. Suppose the value of that SR of one SR is 1 crore, they will finance, if the 25% margin is there, they will finance 75 lakhs. Okay. this kind of financing has become a very good. So as I told you about the role of collateral management is basically to count commodity quality check also and keep the monitoring keep on they will keep on monitoring that stock with periodic audits and all that, and they will also be keeping eye on the what is the prices going on, and they will be advising to the bank if presently the prices on certain periodicity or maybe monthly or maybe fortnightly, they share the prices to the bank that these particular prices of these commodities are this much. So but the prices are going down, in that case they will ask the bank that the prices have gone down, so the value of the total commodity has come down, so the margin will trigger for the borrower. So the bank, according to the bank, will swing into action, and they will issue notices to the borrower to collect the money. So this was all about the commodity finance. I hope now I'll be talking about the various kind of risk which is associated, which is the main theme of this today's discussion. So commodity finance, though it appears a very easy product to be sold, but the most problematic feature of this commodity finance that this is a highly risky business. Risky business in the sense the underlying commodity is a movable commodity. So anytime what will happen that the commodity can be moved from one place to another. If you look at it, if suppose a loan has been given against a fixed asset, the fixed asset cannot be sold or it cannot be moved, or even if it has to be transferred from one person to another, you need to go and the registry has to be again with proper through proper conveyance deed that the ownership will transfer. But in case of commodity finance, simply you lift the stock and transfer it and then you sell it to the market. So it's highly risky business. So because of that, it requires a continuous monitoring. So what kind of basically risk associated with commodity finance? So if any one of many of you might be having some idea about it, then what are the different kinds of risk are there in any kind of financial businesses? There are basically three types of risk are there. First thing is that your credit risk. Credit risk. Secondly is your operational risk, and third is your market risk. So if I talk about, though in case of commodity finance, I have given it, I have bifurcated the operational risk into a quality, operational, and the quantity. But these are all part of the operational risk. And one more thing is the regulatory risk. There are other risks are also there, but basically, broadly speaking, if we talk from the banking segment of these are basically three kind of risks. That is a credit risk, operation risk, and the market risk. Now, credit risk means what is the credit risk? Credit risk means there is whenever any financial institutions or a bank, if it is giving any loan to any individual, there are 100% chances that that particular loan may not be repaid. So the chances of default from the borrower on the part of the borrower will lead to the credit risk. Because if any kind of a default is there from the borrower side, that is a credit risk. Secondly, if suppose there is a credit rating is there, suppose of a client, if that goes downwards, in that situation also that is a credit, because if the downward rating is there of that external rating of the client has gone downwards, in that situation also it will trigger to a credit risk. Second part is that the operational risk. Operational risk means any lapses. If suppose if any lapses on the part of employees who have not adhered to the systems and procedures, let down systems and procedures, which has resulted to any kind of loss to the organization, that result into operational risk. Other than that, also there are operational risks. There are a number of factors are there in the operational risk, like if your operating system is not working properly, it may lead to operational risk. If there is a natural calamity, if there is a fire incident is there, that is a kind of operational risk. If suppose the fire, theft, burglary, it's kind of operational risk to any entity. So any losses which has occurred because of the non-adherence to the systems and procedures, or because of any natural calamity or anything which is out of the control, which is not falling under the credit and the market risk, will fall under the operation risk. Third is the market risk. Market risk means here if you talk about the prices, that is a market risk. Because of the market, the prices of agriculture, commodity, or anything is determined based on the market factors. So it's a demand and supply mechanism. So if demand is there, demand is on the higher side and supply side is on the lower side, the prices will go up. While the supply side is on the higher side and the demand is not there, the prices will be having a downward price trend. So that is the typical, and this is a typical feature in case of agriculture finance. You must have read in the newspaper that every year, every second or third year, the prices of potato goes crash. Means there is a glut. Sometimes the prices of potato or onion goes on skyrocketing, but sometimes the prices go to even 2-3 rupees, 1 rupees kg, and ultimately the farmers is required to throw this crop on the roads because they don't have that much of return. Also, they are not going to get it that they can take care of their transportation expenses. So market risk is the prices. Fourth one is the regulatory risk, which is regulatory risk because agriculture commodity is a there are a lot of regulations are there in terms of the limits are there because you know that in India particularly because there are other poor people are also so the government has to run the public distribution system. So the prices of cannot go up to an extent because the farmers, if the prices goes towards a very on the higher side, it becomes difficult for the government also to procure the commodity and ultimately is translated for people. So the government do bring some kind of a mechanism to control these prices. One thing is that the Essential Commodity Act, you must have heard about it. No, the Essential Commodity Act is basically which brings certain cap on the commodities storage limit. Means commodity storage limit. Sometimes they bring certain kind of a limit to the traders and the processor because what happens sometimes when the prices are on the upper side or the even traders feel that the prices can go upward, they will start hoarding the stock, which will result into a supply shortage in the market and resultantly the prices will go up upward. So this is a part of regulatory risk. So as I told you about the quality risk is what? Quality is a type of operational risk. The quality risk basically why does it arise in agriculture in commodity finance? If suppose a quality of a stock is not proper, I can share my example with you. Whatever the experiences which we have seen in. Suppose a quality, this is basically it is more the importance of it becomes more pronounced in case of those commodities which are high value. Like suppose if you talk about resin or if you talk about jeera, if the quality, the prices of those commodities is very high, it goes up to 170-80 rupees. So if the price and the prices, the quality of that is not up to the mark. If it's a lower quality prices, maybe even 100 rupees, and the good quality commodity might be of 160-70 rupees. So there will be a price difference of. So if the proper quality check has not been done, then what will happen? That the amount of the valuation of that quantity, the commodity will be higher. So accordingly, the higher amount of loan will be disbursed to that particular borrower. So what will happen when the prices will go down? The borrower will never come to lift that stock. He will say that, okay, you keep the stock there and let it be there. So ultimately, it will result into huge quantity. So quality checking is very important, particularly in case of high value commodity, particularly the commodity where the quality does matter a lot, like oil contents, your protein contents, all those factors plays a very important. Secondly, the price risk, as I told you about it, the price risk is suppose the commodity price is highly volatile. As you have said, the last year the prices of maize has gone up to 11-12 rupees. Today the prices are 15-16 rupees because the poultry in the poultry segment the demand has gone down significantly because of this fear which has crept into the in the society that this by eating the poultry product or the broiler may lead to any kind of viral attack. So that is why the prices have gone significantly downward. So similarly, the prices in case of basmati, if you look at it, the basmati rice is basically an export commodity. So the prices actually determined depending upon the export demand. If we used to export around 25-30% of the total basmati rice used to go to Iran. So suddenly there was a sanction against the Iran, and so the demand has squeezed there. So ultimately, so the prices had come down. So that ultimately, so it has got its impact. So many of the commodities which are export oriented or imported, the commodities which are imported, or the commodities having high value, these kind of commodities are more prone to the price risk, prices and price risk. Some of the commodities like wheat and all that, these are relatively stable, but because the price difference may not be that significant. Similarly, quantity risk. The quantity is very huge because the finance is determined based on the quantity. Suppose a proper counting is not done at the field level, the person who is deployed at the warehouse, the supervisor, who has not done the proper quantity check. Suppose there are 1,000 bags and there are 1,000 bags and he has counted only 900 bags or 950 bags with loss of 50 bags. And this particular risk occurs mainly in those kind of finance, particularly sugar or paddy, where there is a huge quantity of stock is actually stored. If you go and visit the sugar mill or a rice processing unit, there is a huge quantity of stock is kept, particularly sugar. The huge amount of these stacks will be there. It becomes difficult practically to count those stock. So the quantity risk does matter. This. For the fourth is the operation risk. If the entire commodity which is at the back and call, or you can say under the control of a supervisor, the person who is at the field level, if he actually goes hand in glove with this warehouse owner, he can open up the gate and he can allow the stock to be lifted. So what will happen then? That the entire, it's an operational risk, because compromise with the borrower or the warehouse owner is compromised. They can indulge in any kind of a malpractices with that and ultimately release the stock, which can result into a huge amount of loss. And that is why, if you look at the experiences of most of the commodity finance with the collateral management, they have faced this kind of problem. That operational persons who are at the field level, he has gone compromised his honesty, and ultimately he has released the stock. So it becomes, and that ultimately resulted into a huge quantity of loss to the collateral management managers and ultimately to the banks. Regulatory risk, as I already discussed about it, and credit risk. So credit risk, as I told you about it, the credit risk, because what is my own experience about credit risk, if I talk about it, that any kind of a huge losses which occurs in case of commodity finance, that's basically is driven by because of the misdemeanor or misdeed of the owner, which may be warehouse owner or maybe a client himself. Because in many of the cases, like bigger cases like sugar and rice processing, most of the time the stock is kept within the factory premises, in the warehouses which are within the factory premises of the. So practically speaking, he can deploy the collateral management, does deploy his own security guard, but practically speaking, the entire control or sway over that warehouses is of the client. So which result into. So that is why the proper due diligence of the client is very much is essential. And although when I joined in the NBHC, I started this particular credit risk assessment, which was never there in, I think no other CM agency was also following it. But what we observed that all bigger losses have occurred mainly because of the borrower selection was not proper. So that is why the borrower selection, though it is taken care by the bank itself, but ultimately the bank transferred that risk to the collateral management. So it is the requirement on the part of the collateral manager also to check the credentials of the borrower also, because ultimately if the borrower is not proper, then that can land the collateral management into a deep trouble in the future. So that is why we have charted this credit risk assessment for the borrowers. I have discussed about this risk in the warehouses go down. So that includes your proper management in the warehouses, including your proper ventilation, firefighting equipment, water. Are all will lead to a operation. If the firefighting equipment is not there, particularly in case of cold storage units, there are bigger chances. You must have noted, or you must have come across with many such news that this particular forest has been burned today, or has come under the fire. And many of the times this kind of fire incidents actually is done deliberately by the cold storage owner. So you have to have a sufficient firefighting equipment, the proper ventilation has to be there. If suppose a cotton, a commodity like cotton or jute is kept in the factory premises or in a godown, we need to see that whether high voltage electricity wire is not there. So these are kind of a normal practical operational controls which we need to take it. One must be taken because any of them may lead to any kind of a bigger losses. So collateral management risk. We discussed about that if the proper quality checking, quantity checking, or there are lapses on the part of the warehouse supervisor who is deployed, or security guard is not been properly undertaking his required into a huge quantity of loss to that. So how do we control how to control all these things that we were discussing in the this part. So as I told about the credit risk. Now how to do the credit risk assessment? Though the bankers are doing it, the credit risk. So but as a CM agency, we may also need to check the credit risk assessment of the have to see the borrowers of the genuineness of the borrowers, their proper background check, and the proper appraisal system also. What happened normally, in most of the frauds, if you see in the agriculture commodity finance, that has individual financing, because what happens that in the name of individual farmer financing, the many beneficiary other which may be a beneficiary owner, which may be a cold storage owner or a warehouse owner, he has taken that loan and ultimately by giving the fake KYC or sometimes even the KYC may be genuine, but practically the benefit of that loan has gone to that warehouse owner or a cold storage owner. So the proper assessment has to be there. And when the problems comes, what happened that suppose a fraud has occurred, because in most of the time in commodity finance, the biggest problem with commodity finance is that the any losses occurs because of the fraud. And when the fraud occurs, it again then it brings forth many other external elements also into the investigation parts, which becomes extremely difficult to handle. This is based on the experience of all the CM agencies. I can tell you that if there any fraud occurs, then other external agencies, FIR and all that will come into that. So that is why the commodity finance in that respect is very risky. So we need to be very much vigilant about those who are at the field level. Ultimately, they also need to understand that one must not compromise, or they should always undertake the proper due diligence and adhere to the systems or procedures SOP which have been let down. Otherwise, it will not only be a risky proposition for their own company bonds, but also for them also for themselves also in the future. So the background check of the credit the client is very important. As in our NBHC, what we have done it that we have also started doing the internal rating of the client. Though banks are also doing it, but we are also doing the internal rating of the client. Now the internal rating of the client is actually determined based on his financial, business, and the industrial risk, which then will take into account all these financial performance through balance sheet assessment. Also, what is the vintage of the client in that business, and what kind of a commodity which is handling. So the commodity risk is very high. So we also look at the comfort of the commodity also. And then based on that, the margin is also fixed. Suppose if a high risk client is there, then the margin, if suppose a commodity underlying commodity is riskier or the client is riskier, in that situation, even if you want to do finance, you need to increase the margin. Margin risk, the contribution of the borrower or skin of the borrower in the business will be higher. Secondly, the risk-based pricing that should be done by the banks also. Normally, what happened that in the name of priority sector lending, banks finance this kind of financing at a very low rate. But now time has come because they feel that ultimately there is a collateral manager who is in between the borrower and the banks, so he'll take care of all the risk. But it does not happen, practically speaking. So that is why if the collateral manager has to discharge their property, it has to be paid properly also. CM agency cannot take this risk or undertake this kind of activity at a very lower rate of 0.5 or 0.75%. That needs to be increased. So that is why accordingly the risk-based pricing system, because higher the risk, higher the pricing will be there to the client. So this kind of a system has to be introduced, although it is there in case of bigger clients, but for smaller clients, the bankers have to introduce. I think they will be doing it gradually, and the frequent monitoring of the client, regular monitoring. Not only one should not see the comfort of the underlying commodity, but also keep tracking the the client performance, whether whether the churning is taking place or not, whether the stock has been lifted within the period of 1 year or not. If it is not, again he is taking the refinance against that commodity, that kind of. And most important thing is that you need to have a individual exposure capping system. You cannot afford, because what I've seen that the CM agencies or even sometimes bank also, in the name of pledge financing, they take a huge exposure against the individual borrowers. Maybe it goes up to 300, 400 crore bigger way to be. But ultimately, that assessment has to be based on certain working capital requirement that has to be seen in that. And CM agency also need to see that whether they can handle such a huge quantity of stock or not. If they cannot handle it, they should not take that exposure. Otherwise, what will happen? Even a 10% of that, because hardly for you are getting hardly for higher exposure, you are getting 0.5 or 0.75% CNP out of the total exposure. But the risk associated with that is even a 5% chances or 10% chances may lead to a total wiping out of your capital. So that credit risk is the important part. Operational risk, nowadays the operational risk has to be controlled through a lot of automation. In NBHC, we have done a lot of automation now, because ultimately even our entire operations, right from the inward to outward to every outward, and also the day-to-day monitoring of the stock. Even now we are thinking about bringing CCTV camera also. Lock seals we have brought in now for all the lock seals means every day the warehouse, the supervisor, whenever he will be locking that, he will do the counting every day. He will report to the center through their app. He will reporting to the head office, and then he will fix up the lock seal which will be numbered. And next day when he will come again, he will take the photograph, and then that will be matched in the system. So a lot of digitizations we have done it. We have done, and we have revamped the entire SOPs also. Every step by step, we have detailed the SOPs so that it will be easier for the field people to check it. On the quality front, quantity front, we have brought it many, the payment part, on the payment part and the valuation part, we have brought many initiatives through automations. Quality checking, we have brought in many, we have introduced many things like sampling. Sampling, now we have specified that the sampling of the stock, because based on sampling, the price, the quality is determined. So the sampling has to be done by the independent sampler, not by the warehouse owner or the supervisor who is there in case of particularly critical commodity. Then operational risk can be controlled through frequent auditing system. Audit means the frequently independent audit system will go and they will be checking it, and the frequency of audit will be determined based on the risk profile of the warehouse. So what we have done it, that the risk profile of the warehouse is determined based on the risk. Maybe if suppose a client was earlier NPA, or the stock has not been rotated properly, or there was a certain adverse remark given by the earlier audit remark, observation and earlier audit observation. Based on that, we have determined the risk profile of the warehouses, and based on that risk profile, the risk profile of the warehouses, the audit frequency is decided. The higher the risk, the frequency, the lower will be the frequency, because frequently the audit will be there. Now, human resources. The human resources means the rotation of the supervisor or field level people has to be there, so that if any kind of a misdeed or misdemeanor done by the US, it will definitely come into the light, come into the notice of higher authorities, and then then the proper mitigation measures or proper remedial measures can be initiated. Insurance, we will be discussing about the insurance. That is one of the most important part. Insurance is now what happened in case of commodity finance. If you look at the collateral managers who are managing the show for the banks, they are handling the huge quantity of AUM, the asset under management. If you talk about NBHC, at one point of time, we used to handle around levels balance sheet worth of coverage. What we have done is gradually we are we have actually brought down that AUM level to a manageable level, because higher the AUM, higher will be the risk. So because if any kind of incidents occurs, the insurance cover has to be there. Because if you look at it, the most of the CM agency, their capital base may not be higher more than 100, 200, or maybe 300 crore. So against 300 crore, how can you cannot take exposure very high. If at all, if you have to take exposure, then it has to be backed by the proper insurance coverage. So insurance coverage is actually basically three types of insurance coverage is there. The first is the fidelity insurance. Fidelity insurance means any losses which has occurred on account of the misdemeanor or any kind of misdeed which is done by the collateral manager own employee. If they are involved in that fraud, in that case, the insurance will take care of it. Then the crime insurance. Crime insurance means that insurance which is actually take care of the fraud or the risk associated because of which arises because of the any misdeed done by the warehouse owner or the cold storage owner. And third is the your fire and normal allied burglary insurance. That is a normal insurance in case of fire incidents or the burglary or any normal perils that take care of this. What is the problem in the insurance is that insurance company is not readily available because they feel that this business is risky. So they are not giving the full coverage. So mostly if you talk about, they will not give the coverage of more than for 25 or 50 crore rupees. So that is why accordingly the quality tailor their the total uh, business model accordingly so that they do not take the undue risk in this kind of business. Market risk, as I told, as we discussed about the market risk, that is a price risk. The commodity prices goes downwards, it triggers into a margin call. If the margin call is not paid by the borrower, ultimately the banks will have to swing into action. They will have to sell the stock in the market and recover their money. If the banks have not actually taken the step immediately or at the right time, what will happen? The price, the value of the commodity will go down so that not only the margin will get totally eroded of the borrower, but even the bank's finance will also not be recovered totally. So that is why, as and when the margin call is depleted more than 5 to 10%, if suppose a 25% margin is there, if the margin is depleted more than 10% or only 15%, so by that time the banks have to the banks along with their collateral management, they should swing into action and they will start the auctioning process immediately basis so that the price so that by the time it is auctioned, at least the bank finance parties gets recovered. So the quick unwinding of the commodity when the price dips below the threshold level, that must be done. Otherwise, what will happen? It will lead into losses to banks and the collateral manager ultimately to the banks. Now the commodity hedging and all that long-term forward contract, which is all well forward and future contracts are there. But that is basically not presently available for the banks. Or banks are not taking it. The banks are it's not available. So these are all about regulatory risk. I talk about that like FSI, every commodity being a which is by the human, it's a lot of licenses requirements are there. FSI license they are accredited by also there with that the license has to be there. This kind of regulatory requirement, if it is not adhered, it can lead to into a problem at any time that storage structure can be taken, the control of that storage structures can be taken by the government authorities, and even they can blacklist that warehouse or collateral management agencies. So this kind of regulatory risk has to be taken care of normal commodity financing businesses also. Now I will discuss about the high value commodity risk and mitigations. That is more or less it is on the same or similar line what we discuss about that. Here the quality risk is very high, and moreover we have to see that the particular commodity which has been financed there, that is actually consumed or produced in that particular area. Suppose if you are financing a coffee in a Rajasthan, that will become it will become extremely difficult to auction that stock in the event. The geography, the finance has to be done only in that area where it is actually grown or where it is actually consumed. So in high value commodity, the geography risk is there, which has to be taken care of that this particular commodity is grown there. Quality risk, I already told you that the quality does matter in case of it does matter in case of high value commodity. It has its own implications, and the price also because of the wide and the storage structure. Sometimes some storage structure requires a specific kind of storage, particularly cold storage, temperature, and all that has to be done properly. And ownership risk. Ownership risk, because if the high value commodity is, although this risk is always there in case of individual financing, this kind of problems which we have seen it, that if in the name of farmer funding or in the name of individual financing, some other party or entity takes the benefit of that loans, which ultimately in the event of any problem, then that individual will come to the picture and say that, okay, no, we are not actually taken finance, or the benefit of that loan or the loan process has gone ultimately to the third party. So it becomes difficult to manage all this thing. And lastly, we will discuss about the cold storage funding. Cold storage, as you know, in normal warehousing, we get a lock and key. But in the cold storage structure, the lock and key is not available because it's a highly cold storage. Normally, the multiple depositors are there. Moreover, it's a technical things to be handled, particularly lock and key is remains predominantly with the cold storage. So that because of that, a lot of frauds have occurred. Uh, in cold storage financing, because you don't have a lock and key, the complete control is there of the cold storage owner. So what does he do? He does not issue a proper cold storage receipt. Sometimes he will release that stock, or he will not pay to the bank, or he will release that stock to the farmers, or maybe in the name of farmer, he, the cold storage owner himself, will be taking a loan against that. So the proper control is not there in case of funding. So in case in that pool source funding, though it's a risky business, but ultimately it is the requirement also. So what we should do normally, we should do the due diligence of the cold storage owner also. And sometimes we should do the financial assessment also, what we are presently doing in NBHC also. We are doing the financial assessment also. We also given a specific SOP for cold storage financing, that it should be properly, the tax saving should be properly there. Cold storage, the stock register has to be properly maintained by the cold storage owner. The stock reconciliation has to be there. The stock confirmation should be given by the cold storage owner on certain periodicity, 15 days or 1 month time. And the temperature control system has to be checked properly. Dedicated security guard and dedicated supervisor has to be there. And sometimes we insist that the court of the owner should also keep their VDC or VDC to take the exposure against the entity, the farmers or the other traders who are keeping their stock effective. So, factory. So these are the and the so audit also frequency is higher in case of cold storage funding. So this was all about the financing against the agri commodities and the risk associated with, and also the probable mitigants in this kind of finance.
Yeah, thank you very much, sir, for making us understand different aspect of collateral finance. It was really a very comprehensive presentation. So I'm so thankful to NBSC not only for understanding the importance of this kind of interactions, but also deputing a senior officer to help us understand this important concept of collateral finance. I'm also thankful to our DG sir, because as I mentioned, it's a 3-year-old program, and we primarily are sharing our content through that online platform MOOCs. But he was very particular that whatever we can do to improve the learning of the candidates, those steps should be taken. And it was his suggestion only to start something like this, that we can invite senior experts from the industry, because it is always better to listen to these experts, the kind of experience they are having, that will increase the value, help us increase the value of this program manifold. So I'm also thankful to DG sir, and of course I'm thankful to each one of the participant who today participated in this online session, in this guest lecture. Not only for the participation, firstly the number is very good, because as I said that we are having roughly around 500 candidates enrolled for this program, and out of 500, at one point of time around 90 candidates were there participating, listening to user. So firstly I'm so
Yeah.
thankful to the candidates for the participation, and secondly for the involvement, because many time in online programs you can participate in terms of number, but involvement is also very important. And it's really a very good feeling that means so much of involvement from the participant side was there. So thank you. That encourages us also, because when we are organizing a program like this, it encourages the expert. It encourages the organizer to organize more program like this. Thank you very much to each one of you for your participation, and on behalf of Manage, on behalf of each of the participant enrolled in this program, I once again express my gratitude to you, Abhay sir. Thank you.
Thank you, Dr. Shalendra. Thank you all, and best of luck. Thank you.